This evening session, we're going to be reviewing basically broad market analysis, and we're also going to be looking at some individual plays, some individual stock selections. Let me introduce myself. I'm Ed Baylog. I work with directly with Baron Wagner and produce the Wagner Daily every day. And also joining us this evening is Rick Petticelli, and Rick does the stock sheet for us. He's been with the company since its inception, and he does a great job with the stock sheet. And both Rick and I will be discussing the broad market, what's happening in the indices, and also looking at individual plays, and then fielding questions at the end. So if you could hold your questions to the end, and what you can do is just type in any questions you might have. And I'm also going to go over one of the trades that we got into today. We got an EUO today, and I want to go over that trade. What I wanted to first do was talk about the New York Stock Exchange, because this really served for me as a leading indicator as to what was going to happen about a month ago before the market cracked. I'd shown this in a previous webinar that the NYSE had formed a head and shoulders pattern. This with the left shoulder, the head, and the right shoulder. And then, of course, since then we cracked, and now we've been consolidating in a very whipsaw back and forth pattern here at these lows, right between 7,600 and 7,000. And one thing you'll notice is that the NYSE has shown a lot of relative weakness to the broad market, in that we couldn't even get back up above the 20 period EMA in this last little rally up, this last reversal over the past 2 days. We just touched it today and then sold off to close at the lows of the day. Now, today we did get a distribution day in the market on the NASDAQ, on the CompX, where we gapped down, we rallied. We gapped down in the morning, we rallied, couldn't hold the rally, and then sold off to close near the lows of the day. What's important is we had a spike in volume here, and that spike in volume tells us that institutions were selling into this move. There's still potential for further upside in the market here. We still could hold this level because volume hasn't been exceedingly great. I mean, you can see there's our 50-day moving average volume, this green line right here. We haven't had any volume that's been over the 50-period moving average volume over the past couple of weeks here. So it's not like there's been wholehearted selling out there, but it still was a distribution day today. So that's of concern. This market is still showing a lot of internal weakness. The market's really struggling. Therefore, we just have to be careful. You have to be careful on the long side of the market still, and it's going to take this market a while to repair itself. As far as some plays that I've been looking at, one that we sent an alert out for today, EUO. Initially, we had viewed this as a pullback candidate. Initially, in last night's newsletter, we thought that if we got a pullback into this range right here, that it could offer a buying opportunity, and it was mainly because we saw this massive spike. We saw this massive spike in volume. We get the breakout move, and basically, what we were looking at here was for the pullback into the support level potentially, and we felt that way because we broke and closed below yesterday's 2 days ago's low. So yesterday we closed at the lows of the day below the previous day low, which would have indicated that we would see some more selling activity and we could pick it up on a pullback. However, we got a massive reversal today. We gapped up and reversed, and in the pre-market we sent out an alert that we were going to get in above this candle, yesterday's candle, which would have been the 7th, September the 7th candle. So we got in above that candle, and we got another big spike in volume here, and we closed right at the dead highs of the day. So basically, uh, we expect some stalling action. I mean, I don't expect this to go straight up. I think what might happen is we might run into resistance here at the 200 period moving average, which is what you would expect, and then get some stalling action, maybe a pullback and some stalling action, sideways action, and then setting up for the next move higher. But for right now, we do know that we have resistance here at the 200 period moving average. And we also have some resistance at this horizontal level around $18.10, 12 cents. That was our last swing highs that twice we tried to get through. But it looks like we're in full-fledged, in all likelihood, full-fledged reversal mode here, especially if we set a higher high. That's our first major confirmation. So we like this trade a lot, and it seems to be working out pretty well so far. Some other potential plays out there. Here's one that I liked, EFA. What I liked about this particular ETF is that during this last sell-off, we sold off sharply and then we undercut the swing low right here at 49.70. We undercut that, we reversed off of this, but notice that when we reversed, we never even made an attempt to get back up to the 20 period EMA. So this is obviously very, very relatively weak. We never even, in the last rally going back a couple weeks ago, we were not able to even get up to the previous swing high. So now today we got a reversal candle, we gapped down, tried to rally, sold off, close near the lows of the day, and we have a reversal candle in place. If we get back below this reversal candle, this $50.33 mark, back below this, EFA offers a potential short entry. And of course, if we break this swing low here, all bets are off. If we get below that $49 mark, give or take, there isn't really much to stop this from dropping all the way down, at least to this swing low, the $46 mark, and that's going back all the way to last summer. So EFA is under a lot of stress right here, a lot of duress. But in bear markets, you have to be careful because you can get whipsawed real quickly. Another trade I like is ILF, which is Latin America on the short side. Notice with ILF that we've had over the past 4 sessions, we've had a real tough time getting above this these 3 candles right here. We've struggled, and in addition, we've struggled to break below this this support level. So these 3 candles are acting as support and resistance. We're definitely fighting to stay within this range. Now today, it wasn't the greatest of all reversal candles, because we would like to have seen it really overcut here. For it to be an ideal reversal candle, normally we would like to see today's candle do this, have a longer tail on it, something like that. If you saw a really long tail where it overcut this 2-day high, this 3-day high, and then came back down to close where it did down here at the lows of the day, that's ideal, because that really means that you swept all the stops and you suckered everybody in. You got everybody long and then turned around and reversed it. That tends to add a lot of fuel to the process, and gets people on the wrong side of the market, which is what adds the fuel to the move. In this case, we did have a reversal, wasn't that severe, and we're sitting right at the 2-day low. So if we were to gap down or sell off with some volume behind it, we could go down and potentially test this swing low again. But for the moment, like I said, ideally, I'd like to see this overcut this 2-day high, overcut it, and then reverse. But there is a strong enough signal here to take this short if we get below yesterday's low. By the way, going back to the EUO for one moment, I just wanted to mention that in this type of trade, just to be more clear about this, that there were two potential setups. Forget about today's candle for a minute. Let's pretend like that's not there. When you have this particular type price action yesterday, as I mentioned earlier, we were initially looking at it to be an entry on a pullback, but what makes the entry today just as powerful is because you did reverse. You got everybody trapped on the short side. Everybody was expecting this. They were expecting it to pull back. You have a sell-off day when you close below the previous day's low. Well, because you trapped everybody, everyone's gets short here. They think we're going to have further sell-off. As soon as you do this reversal, it's like a shock to the system. You gap up the next day from these lows to this open. It traps all the bears in, and of course this is an inverse ETF, but it traps anyone who thought the euro was going to rally, and offers a lot of fuel for a very powerful move up. But you can see that in any particular setup, a lot of times there's potentials for it to go, for the setup to be valid in under several different circumstances, as with EUO. Another one, the emerging markets seem to be weakening here. We'll see how it plays out, but VWO, another emerging market ETF. What I like about this is that we close at the dead highs of the day yesterday on the 7th, which would have been Wednesday. Today we gap down, reverse, and we closed near the dead lows, and we attempted to rally intraday, couldn't do it, and then we closed at the dead lows and below the 9.7 low. What I also liked was this big spike in volume, because what that tells me is that that there's distribution going on, that institutions were selling pretty vigorously. So this rally the previous day, look at how light the volume was. We rallied on virtually no volume on the 7th, and then today we turn around and we sell off on a big spike in volume. So below yesterday's low, or today's low, I should say, below this level, VWO provides a short opportunity. Now let's see here. I'm going to turn things over to Rick. Pass the desktop over to him and let him give you some commentary, a little bit of discussion about his opinions of the current market state of affairs, and also go over some potential plays with us. So hang on here. I'm going to turn things over to Rick.
All right, so we're first going to go into a few setups that short setups that we played last week, and basically just to show you guys what we look for on the short side. And last week on 8/31, we had a reversal bar in DKS after a nice shakeout, the prior swing high up into the 50-day MA. Notice the volume on the rally was pretty weak, declining the whole time. So this little reversal bar here, we just waited for the low to be broken the next day. So on 9/1, we went short, and we had a really good cover after 2 days down. When the market got down for the second day in a row on 9/6, we covered at the open just to take a quick profit. Basically, I think it would have been wrong for anyone for us to let this trade ride down to the $30 mark. But given the sharp 2-day sell-off, we felt that it was just best to take the money and run kind of and wait for another bounce, which one could have gone short today with the tight stop above the 2-day high, or a longer-term trader could actually put a stop above this swing high here, but a tight stop right above the 2-day high wouldn't be a bad end here, with a target of around the $30 area. That's DKS. Monsanto, we kind of did about the same thing. We entered. See the stalling action over here. 50-day MA. We got short below the 830 reversal bar on 831, and we closed the setup. We closed the trade about right here for a quick 2-day move. And basically, for those who are new to shorting or trying to learn about short selling, basically the steps you'll see here, break these charts, pull these, go to a longer time frame here. These stocks have all broken down below the 200-day moving average, which is this orange line. And they're well below the 200, the 50 trending lower. Monsanto's been dead for a long time, though, so it's a little different story. And lows, as you can see, well below the 200, the 50 MA trending lower. So what we do is basically look for stocks that are relatively weak to the market or as weak as the market. You don't want to be shorting anything that's above the 200-day MA right now because the market is below the market, the S&P, the NASDAQ. They're all below their 200-day MA. So you want to be shorting stocks that are at least below their 200 MA. And this is a pretty good example. You just wait for a bounce and for some reversal bars to form. Low bounced, pretty sharp sell-off here. Here's what we would call a base at the lows, or like I think people call them as a ledge, maybe. Base at the lows. Here's a breakdown. Here's a short bounce right here. Then here's the overcut on 824. Notice the sideways action for the stalling action at the 20. We got short on 831, and we covered right here at the open for a quick gain. It's like let me see what that is. 8% gain in 3 sessions, and that's near the support of the prior swing low, so it's not a big deal. We just got out and basically took the money and run. But basically, the idea is to not fight the trend here, go with the trend, wait for a bounce. And Monsanto, Steve, you want to know where we exited? Right here. We should have held for one more day probably, as we did the other position, but we want to take some profit, so we got out near the lows of this day. And that was the quickest gain out of all of them. So that was about a quick 5% move. Normally we hold for that exit is 9.2, Steve. So usually we'll hold for 10%. But we felt that Monsanto had sold off pretty strongly that day, so we just wanted to take the money and run and get some profits going. And then once you get profits, then you can build in on those profits, which is what we're doing now. Anyways, with DKS, Monsanto, and low, we all covered for gains. So now we're in a position of strength here this month. So now our new short setups that we're looking at are VWM. And VWM here stalled out the 50-day MA on 831 and 9.1. Pulled back and has reversed back into the 50 here. And that's formed a reversal bar today, overcutting the prior day's high. Now, a trigger would be below the day's low tomorrow. You got to be careful though. In the first 5 or 10 minutes of trading on the open, they might run the traders here at the open. Sorry, and suck them in, as they would say. And you got to just make sure that after 5 to 10 minutes, that there's not a big reversal and the market rallies straight back up, and it could provide another shakeout over the 50-day MA. So what I'm basically saying is, you want to just be careful on the open that you just don't go blindly short at 89.50 and then have the stock reverse on you within 5 to 10 minutes and take you right back up to $95. That was VMW. CRM, not strong as a reversal bar, but it's still a potential short setup here. As you can see, it's well below the 200-day MA with the 50 MA going lower. It's bounced already into the 20-day MA. And there's a little bit of a reversal bar. I get the entry here would be below 123 with the stop above this day's high. Fossils, first crack here. So this is a little bit of a bounce, a little bit different. Right at the 200 AMA, this has a little bit of relative strength, but it's just had a real, that's a pretty ugly sell-off. So Fossil's probably going to end up testing $75 levels soon. Whether this is the reversal bar and the entry is here, or you might see a few more days up to the 50 MA. That's something to look at. It's a little bit more aggressive as the trend hasn't completely reversed, but that's not anything I want to go long when something gets basically obliterated like that below the 50 MA. AJU is another potential short setup here with a reversal action. Today, overcut this 10-day high here, 10-20-day high that was set on 8/31. Maybe an entry below the 2-day low, stop above the swing high. Look for exit around $80, maybe even 77, 76. And let's go over one more here. UA is decent. Let me try CXO. Here for some oil. CXO's rallied into the 50-day MA. The 50 is below the 200. Below the 2-day low and the 20-day MA could have the stock spark a sell-off to the $75 area. And your stop would be above the 2-day high. So basically, it's all the same. You have a stock that's sold off, that's rallied into resistance and formed some sort of reversal signal. And that's basically your short entry below the reversal bar low the following day. And as far as long, we're not really entertaining anything on the long side right now. We're basically we're building a watch list. But the moves are just too wild. They're too loose, and there's nothing setting up really nice. The best setups I could find on the long side right now are Q-Core, holding above the 50-day MA. Pretty tight range, but still, from here to here is an 11% range. We'd like to see that tighten up a bit. Still a little too wide, maybe to get tight stops on. IDC is another one, IDCC. Probably as a buy entry just over this $71 level. Again, I don't really know if I'm going to put these trades on. I don't really think so, but I'm just showing you guys what's out there in terms of long setups. The market atmosphere is just, you don't really want to go long right now. Jazz has held up pretty good, but as you can see, this is pretty wide here. If we come back, look how tight it is over here. That's really what we want to see long setups look like. And over here, it's wide and loose and just hard to have a stop in, untradeable really. And over here, it's tight, beautiful setup, nice tight breakout action. Stops are probably in the 4 to 6%, 7% range. Around here, you're gonna have stops in the 10 to 50% range. I don't know how often you're going to get a 30%. If you're looking for 2-to-1 reward to risk ratios, if your stop's 5%, then you're getting 10 to 15% return. That's great. But when your stop's 10 to 15% wide, how often are you going to get a 30% rally move in the market? Right in this market especially. So if you're looking at a 7% stop and you want a 15% return, I don't know if it's going to happen right now. So that's what happens when the risk reward ratios aren't in your favor. On the long side, that's the reason why we'll say that is just, you might risk 7% to make 5% or 8%. That's not a good ratio. So definitely the risk reward ratios favor the short side right now. And that's all I have for you guys tonight. Ed, back to you.
What I wanted to talk about was a little bit of the psychology of trading and in markets, what happens, especially in bear markets. I have a saying, and it's a little bit morbid, but before I get into my saying, there's really four emotions that really drive the market, and they are greed, fear, hope, and finally regret. That's the one that I think gets overlooked a lot. You really don't hear that one talked about very often, but you have regret. And the two that I think are the most dangerous actually are the hope and the regret, more than the fear and the greed, because they're easily understood and seen. It's the other two that sneak up on you. But if we look at the complex, one thing I say about bear markets is that nobody nobody ever jumps off of a building and kills themselves because they're too greedy. So when markets are going straight up, you never pick up the newspaper and hear that somebody jumped off a building because of greed. But when fear kicks in, when markets fall apart, sadly, people take their own lives. So that gives you an idea of how powerful the emotion of fear is. It's the most powerful emotion out there. It's a survival response. And let's put it in perspective. Taking a look here at the chart of the NASDAQ composite. From someone popped up there. We got somebody on the webcam. I don't know how that happened. You'll notice that starting back in last August of last year, a year ago, we rallied, we broke out, and we hit the highs of that rally around May. But for all intents and purposes, from about, let's say, from February until just recently here in July, August, we've been in a trading range. We've just been trapped in a trading range here, bound by this region right here. Okay. Now, what happens? It takes us from August until basically July, a year to rally, and we stay up in this range. And then within a couple of weeks, we lose almost everything from this breakout. We're almost back down to where we were last summer within a month. I mean, not even a month, 12 days. We lost it all. So what took a year to build took 2 weeks to blow up. And that really demonstrates, I think, more than anything, the power of fear in the market. And you've got fear, and you've got issues in the market when you see this kind of volatility. Where here, look at the average daily trading ranges; they're very narrow. Each of these candles, the average daily trading range is pretty typical. But when you get to this sell-off, notice how the candles lengthen. You get extreme volatility, a huge pickup in volume, and even in this consolidation zone, every candle, I mean, every day anymore, if we don't rally or sell off 2% or more, it's almost like the market's sitting still. A 1% move in the market is boring right now, whereas a 1% move going back 6 months or a year was a huge move. Well, as long as we continue to see that kind of volatility, you've got to really be careful in the market. And you also, this is not a time where you get overly aggressive in the market, and that you don't honor stops. If you're wrong, and frankly, you shouldn't even be on the long side of the market. But if you were on the long side of the market and you were wrong, this is an environment that you have to get out quickly. You can't second guess yourself. You can't sit around and debate and hope that the stock comes back into your favor, the ETF comes back into your favor, because you can get obliterated. And by the way, the volatility holds true on the long side also when you're in a downtrend. We have so much, when you have negativity in the market, you got to remember something about the market and its structure. The market is biased to the long side, meaning over the long run, there's always going to be more buyers than sellers in the long run. Otherwise, there's no reason to have a market. Every market would go to zero. We would be assuming that markets would never grow, that societies would never advance, that business would never advance and prosper, and that all markets would go to zero. And if that were the case, if you didn't have the bias to the long side, then everyone would always lose all their money in the market, and there'd be no reason to even have a society for that matter. And because of that, you're going to get moments in time when you're in a downtrend where buyers step in. Big institutions decide that enough's enough. The prices have fallen enough. We're going to buy here. They're going to step in, and it'll cause massive whipsaw rallies, which is very indicative of bear market activity. And even if you're in a downtrend, you can't argue with that. When it happens, if for instance, you might have a week where you're down 1,000 points. Well, the next week you could be up 700 points. And you and I could debate and argue about why the market shouldn't be doing that, and why that's irrational, and why are people buying here. But at the end of the day, there's the old saying, the markets can remain irrational longer than you can remain solvent. And that is very true. And the biggest lesson, I think, when you're in these kind of environments, the biggest thing you can keep with you is don't get caught up in that hope mode where, oh, I hope it comes back, or I'm going to double down here and take on more shares because I was wrong. But if I just double up, I can make it back. That's very dangerous to do, especially during times of volatility, because you can literally wipe yourself out. It's hard enough. It's something you wouldn't want to do in normal times, but during volatility, it's a formula for disaster, and that's where hope plays um, a really important role. You can't get it. You can't get into hope mode. If you're wrong, you're wrong. You cut the trade. You move on. And the regret thing, I think, plays a big role because people will miss a move in the market. For instance, something like we were talking about today, EUO. EUO, basically, we got the big reversal breakout move today. A lot of people might say, oh, they regret that they didn't get in here. I mean, okay, I mean, you could get in here, but the human tendency is to say, well, I missed the move. I regret that. I want to get in. I want to get in part of the move. So then you end up buying it up here somewhere. You end up buying somewhere around here. Right as we're getting into resistance, then the thing reverses on you, and it ends up coming back down to where the original breakout occurred back in the 1750 range or something. And so you regretted not getting in, and now down here you regret that you got in, and so you get out too early. You just throw the trade away, whatever. You say, I can't take it anymore. I have bad luck, whatever. Well, here's the reality. Sure, this thing could break out, and it could go. I mean, we could end up doing a move like this. We could go straight up to somewhere in here over a couple of day period, but I assure you, nothing goes straight up forever. I mean, you're going to get pullbacks. You get a move like that, you're going to get a pullback, and you're going to get some consolidation. You're going to get a chance to get another entry. The problem is when you enter in the wrong places because of regret. If you enter in the wrong places, that's when you chop yourself up, because as soon as you enter, then the thing reverses, and you give back you give back hard-earned money real quickly. You're down on the trade. You get disgusted. You get out, only to watch the thing rip higher. Well, the reality is you don't chase trades. You'll hear us say this a lot. We don't chase trades. So if we did get, let's say, another gap up tomorrow in EUO, and it was up near 19 bucks, that's where we'd be looking to take profits on this initial trade in all likelihood. Okay, so not that wouldn't be where would be buying. What we would, however, do is put this on the radar and be looking for a pullback and then some consolidation for another setup. And that deals with some of the psychology of trading. But do remember, in this environment, I got to recap this, that when you're dealing with massive volatility, it's dangerous to not honor stops and not keep your position size under control, taking on too much size. One last thing I want to mention is something I keep my eye on during volatility and during bearish environments is the VIX. And I think we spoke about this last week, but I'm going to do it again real quick. As long as the VIX holds up, you notice how we had a breakout move right here. We broke out, we consolidated in a pennant-like formation, then we broke out again, we had a little bit of a pennant going right here, but now we've gotten some really wide, sloppy action. However, uh, what's what's still happening though is the VIX is holding up. We're not seeing a sell-off in the VIX. We're not seeing a volatility contraction yet. Volatility is continuing to rear its ugly head, and as long as the VIX holds up, and we're not seeing a massive pullback and test of support, that tends to tell me that you got to be really careful about thinking about being on the long side of the market. It's just not a time to be long here. The market has to repair itself. That's all I got to say about the psychology of trading and so forth. We're going to turn this over to questions now, and I'm going to see what questions are out there and answer away here. Just type in any questions that you have into the chat room, and we'll answer what we can. All right, there's a question here about our take on SH and gold. Gold is a classic example of the comment I just made a moment ago, that the market can remain irrational longer than you can remain solvent. Anyone trying to short gold over the past 2 years would have had to have been out of their mind. It doesn't matter whether you think it's worth $2,000 an ounce or not. It doesn't matter what your opinions are on the supply and demand issues, or whether gold should be at $100 an ounce or $2,000 an ounce. Where is gold right now? Gold is at $1,800, $1,900 an ounce. That's the market's opinion is the only one that matters. Now, having said that, I certainly would not try to short gold here by any means. There's no, we're in such a massive uptrend. However, there is a warning signal going on that we may be nearing the end. We're getting into a severe overbought state, and that warning signal is volatility. This is not tight price action. Look at how whippy this price action is. Big V moves. That's not what you want to see when a stock is looking to move higher. Here's the kind of price action you want to see right here. You want to see consolidation, a contraction in volatility. You want to see sideways consolidation, contraction in volatility, and then a breakout move to go higher. What you don't want to see is this kind of activity, because it indicates that big players are starting to potentially get out of the market. Now, gold could continue to rally from here. It certainly could, but there's just, in my opinion, there's just better plays out there than to mess with something that's showing this kind of volatility. And look at this volume pickup. I mean, this is the biggest volume we've seen in a long time in gold. And frankly, really what you're seeing here is a ton of volume is hitting gold, a ton of volume's coming in, but it's really not going anywhere. It's just churning around. So you have a massive spike in volume recently, but we're really just not going on a percentage basis, really going all that much higher. We're just sitting there. So that, I may not know a lot of things, but I know when there's a sign of something being in an overbought state. I certainly wouldn't short it. It's still in an uptrend. It would be foolish to do so, but I would not be someone who would be really interested in buying gold here, because you're not going to get these clean setups. What I care about are clean setups, consolidation like that, consolidation like this, periods where you get a contraction in volatility, nice sideways action, and then breakout moves. Nice sideways action, breakout moves. This choppy stuff is not good. SH, let's take a look at that real quick. Well, as you would expect in a trend reversal, when you're looking on the short side of the market, volatility is actually more your friend. This price action isn't really tight, obviously, but you wouldn't expect price action to be tight during a bearish move. However, in order for SH to take its next move higher, we would want to see a little bit of contraction in this action. It is pretty whippy, but the bottom line is this would be the side of the market you'd want to be on right now, and we're above all of our all of our moving averages. We're riding along the 20-period moving average, and more or less, I don't know if you call it consolidation, but we're moving sideways in a wide trading range. And like today, we got a big reversal candle here. Here's a reversal candle. We closed near the highs of the day. I mean, potentially SH offers an entry above yesterday or 2 days ago high around 44.50. Potentially offers a long entry there. But I would say this, that one thing that does concern me a little bit, I'm going to take a look at the comp X here. What concerns me a little bit is this candlestick pattern right here. There's two things that we could still see another little move up here, because a lot of times, whoops, wrong one. This particular candlestick pattern, I'm always on the spy for. I'm always watching for this, where you get a nice up day, volume increased, we broke above resistance of the 20 EMA, nice up day. Then we get a reversal candle day where we come back down into the body of the previous day's candle. This is quite often a bullish candlestick pattern, a bullish setup, where in fact what ends up happening is you have one more day or a couple more days to go up from this. And so I see this candlestick pattern all over the market right now. I'm seeing it all over the place. So I am a little cautious that we could get one more little burst up, sucker everybody in on the long side, and then reverse it. But for the moment, if the setups are there, they're there. You take them and you honor your stops. There's a question here about long setups in a sideways or to down market. Steve, honestly, in this type of environment, I mean, in a sideways market, if we were still in an uptrend and we were going sideways, there'd be plenty of long setups to look at, and we'd be more than happy to entertain those setups, because that's just known as consolidation. You have a volatility contraction, you have consolidation, and normally the trend is going to resume in the direction of the if you have consolidation, the consolidation is going to resume in a move of the original trend, the same direction as the original trend. However, when you're in a down market, trying to play with long setups is just plain guesswork. You're fighting the trend. There's no reason to do it. You're better off just being patient and waiting for another set of setups to come your way. Allow the market to repair itself, and allow leadership to come back in the market. And right now we have no leadership. And one of the reasons you don't want to even think about trying to get long when there's no leadership is something I've noticed over the past several days is you'll have former leaders, or things like IBM, for instance. I mean, look at this reversal candle in IBM today. Things weren't all that bad, but IBM, they just sat on that thing all day. Now it's still above the 200 period moving average, so I'm not really inclined to try to short IBM here, because we're still above this critical moving average here. But you can see this is what's happening. They're sitting on the really quality stocks. 2 days in a row, IBM can go nowhere. Yet they're buying the garbage. They're buying things like Finisar yesterday, stuff that's been obliterated, and we have bottom feeding going on right now. Look at this big volume spike. And what are we doing? We're buying Finisar, something that's just been obliterated, which is very characteristic. So, I mean, look at Finisar. Why would I want to try to buy Finisar after it's gotten chopped in half by 2/3? I mean, that's just bottom feeding. I would rather buy things that are at highs looking to break out once the market repairs itself. But this is the kind of stuff that gets they'll start buying, and there's no reason to buy it. It's got so much resistance everywhere. I mean, look at this volume day where it tried to break out. It went nuts, and it just got slammed back and closed near the lows of the day. That's the problem with trying to bottom fish. But that's the price action we're seeing right now. GMCR. That's one strong stock. GMCR is wow. I mean, you've got just a great great uptrend here. Obviously, this is one of the few leaders left in the market. However, once again, what don't I like? I look at this price volatility, and look at the average daily ranges here of these candles. Yeah, this is a strong stock, but we're fighting the trend. We've got volatility going on. You don't want to short it. I wouldn't short it, but certainly until the market repairs itself, it's very unlikely that GMCR goes anywhere. But this would be on our radar as a candidate, as a stock that, as the market continues, once the market begins to repair itself, we get some consolidation, and the downtrend ends. These are the kind of stocks that you look for as breakout candidates. You don't bottom fish with Finisar. You look to find things like GMCR. Starwood Hotels and Resorts Worldwide. I mean, this is just a really bad looking chart. This reminds me a lot of, there was one I showed earlier, I think it might have been a EFA, that it's just so weak, it's not even rallying with the market. I mean, it couldn't even get back up to the 20-period EMA here. I mean, you could have some basing out going on here. Like I said earlier, we could still get another little bounce in the market here. But right now, this is pretty weak. I mean, this is a bad looking chart. And you can see where we're at right now is we're right at this swing low. We already got down to last summer's lows. So, you could get a bounce here, but this isn't something you want to buy. Green Mountain is what you would want to buy if the market were to repair itself and begin the next phase, another uptrend. So, bad looking, this would be something you would look to short into bounces. And, potentially, I mean, below yesterday's low, hot HOT would be a potential short candidate. But I'm not thrilled about the risk reward on it right here. I probably would rather see it come and overcut this 20 EMA and look to short it on an overcut of the 20 EMA. Another thing I did want to mention was that the volume, because we haven't seen heavy volume in a while here, we haven't gotten one of those really big days where we're over the 50-day moving average for volume. I'm always a little hesitant to get overly bearish, even though we have a lot of nice reversal candles going on. I'm still a little cautious. Normally, what you want to see is a really big burst in volume on a reversal candle. That gives you a lot more confidence that the reversals, another leg down is underway in all likelihood. Starbucks, I mean, it's a typical thing we're seeing right now in stocks that are strong. Starbucks obviously has been in a nice uptrend for a couple years. Now we're starting to see that price volatility, this, real choppy back and forth knife fight going on between buyers and sellers. It's not the kind of price action you want to see for something that's going to move higher. Now, if Starbucks were to tighten up here and let's say, move in a tighter range and tighten it down to stay within maybe a 2-point or 1.5-point trading range for a couple of weeks, then it could present itself as a potential long candidate. But for the moment, I really wouldn't want to go long Starbucks, but I certainly wouldn't short it either because it's above all of its moving averages. And as the broad market's gotten blown up, it's hung in there. Now, at some point, if Starbucks broke below this range, if we get below these swing lows right here, then all bets are off. Then it probably would fall into the category of a short candidate. All right, listen, everybody. I'd love to answer every question I could tonight, but especially with our little slow start there with the technical problems. But it's getting late here, and we're gonna have to wrap it up tonight. I appreciate everyone coming. Appreciate all the good questions. Hopefully, you found our commentary to be useful. We try to bring really, good value-added points to our clients, and we want you to understand, things such as the market structure, the psychology of trading, and how to protect yourselves in the market, not get yourself into trouble. And that's really our philosophy is very basic and simple. The things that we use technically are simple, but they certainly keep you out of trouble. Hey, thanks everybody. Thanks for your kind comments, and we'll see you all in the next webinar. Have a great evening.